Ever wondered how exchange-traded funds, or ETFs, can benefit your investment portfolio? Here's a quick introduction. ETFs are essentially baskets of securities that you can buy or sell on stock exchanges, much like individual stocks. But here's the twist. These funds can track a broad market index like the Nifty 50 and Sensex, or even specific sectors or asset classes such as bonds or gold. This means with a single investment, you can gain exposure to a wide array of assets, offering a convenient way to diversify your portfolio. In other words, instead of putting all your eggs in one basket, you're spreading them across multiple baskets, thus potentially reducing risk. Quite handy, isn't it? Now that we've understood what ETFs are, let's delve into why they might be a great addition to your investment portfolio. Diversification, low costs, and high liquidity sounds enticing, doesn't it? These are just a few of the many benefits that come with investing in exchange-traded funds, or ETFs. Let's delve deeper into these advantages. Firstly, ETFs offer instant diversification. Instead of putting all your eggs in one basket, you can spread your investments across a wide array of assets, reducing your overall risk. Secondly, cost-effectiveness is a key attraction. ETFs typically have lower expense ratios than actively managed mutual funds. This means of your money goes towards your investment and less towards fees. Thirdly, ETFs provide remarkable liquidity. Unlike mutual funds that only trade at the end of the day, ETFs trade throughout the day just like stocks. This gives you the flexibility to buy and sell shares at any time during trading hours. Fourthly, ETFs bring transparency to your investment. They provide daily disclosures of their holdings, so you always know what you own. No more guessing games about where your money is. Clearly, ETFs bring a host of advantages to the table. But like all investments, they come in various types. From stocks to bonds, commodities to real estate, ETFs have it all covered. Let's dive into the different types of ETFs. First up, we have stock ETFs. These track a specific stock market index or sector, allowing you to invest in a wide array of companies with just one purchase. Next, bond ETFs. If you're looking for a more stable investment, these might be your cup of tea. Bond ETFs invest in a basket of bonds, providing a fixed income stream and potentially lower volatility. Then we have commodity ETFs. These track the price of physical goods like gold, oil, or agricultural products. If you're looking to hedge against inflation or diversify your portfolio, a commodity ETF could be a good fit. Ever thought about investing in real estate but didn't want the hassle of owning physical property? Real estate ETFs are your answer. They give you exposure to the property market without the need for a realtor. Lastly, for the more advanced investors, there are leveraged and inverse ETFs. These are designed to amplify or inverse the performance of an underlying index. But tread lightly, these ETFs can be risky and are not for the faint-hearted. So, whether you're into stocks, bonds, commodities, real estate, or looking for something a little more high risk, there's an ETF for you. With this variety, there's an ETF out there for everyone. But remember, with rewards come risks. As much as we'd love risk-free investments, they're as real as unicorns. Even with the convenience and benefits of exchange-traded funds, it's crucial to understand that they come with their own set of risks. First up, there's the market risk. Just like any other investment, the value of ETFs can fluctuate based on market conditions, which may lead to potential losses. Then there's the tracking error. ETFs aim to mirror the performance of their underlying index. However, sometimes they may not perfectly track this index, leading to deviations in performance. Another factor to consider is fees and expenses. Although typically low, ETFs still involve costs that can impact your returns over time. Lastly, there's liquidity risk. Some ETFs, particularly those focused on niche markets, may have lower trading volumes. This could make it harder to buy and sell shares when you want to. Risks are part and parcel of investing. The key is to choose the right ETF that aligns with your investment goals. Choosing the right ETF is like finding the perfect pair of shoes. It needs to fit your needs just right. So, how do you go about doing that? First, you need to consider your investment goals. Are you looking to grow your wealth over the long term, or are you seeking a steady income stream? Your goals will determine the kind of ETF that is right for you. For instance, if you're looking for growth, you might consider an ETF that tracks an index of high-growth companies. If income is your goal, a bond ETF could be a better fit. Next, think about the underlying asset class that interests you. ETFs can track a variety of asset classes, from stocks and bonds to commodities and real estate. Your choice here will depend on your investment goals and your risk tolerance. If you're a risk-averse investor, you might lean towards bond or real estate ETFs. If you're comfortable with more risk, stock or commodity ETFs could be up your alley. The third factor to consider is the expense ratio. This is the annual fee that all funds or ETFs charge their shareholders. It's important to compare the expense ratios of different ETFs. While a difference of a fraction of a percent might not seem like much, over the long term, it can significantly impact your returns. Liquidity is another important factor. It refers to how easily you can buy or sell shares of the ETF. ETFs with high trading volumes tend to be more liquid, making it easier for you to get in and out of positions. Finally, consider the investment platform. Not all platforms offer all ETFs, so make sure your chosen platform offers the ETF you're interested in. Remember, choosing an ETF is a personal decision. There's no one-size-fits-all answer here. It's about finding the ETF that fits your investment goals, risk tolerance, and financial situation. Choosing the right ETF is half the battle won. Now, let's talk about how to actually invest in them. Ready to jump into the world of ETFs? Here's how you can get started. The first step is to open a brokerage account. This is a type of financial account that allows you to buy and sell various investment products, including ETFs. You can open a brokerage account with a variety of financial institutions, from traditional banks to online-only trading platforms. Once you have your brokerage account, the next step is to do your research. You'll want to look at a variety of factors, including the ETF's underlying asset class, its expense ratio, and its trading volume. Remember, it's important to choose an ETF that aligns with your investment goals and risk tolerance. Additionally, pay attention to the ETF's past performance. While past performance is not a guarantee of future returns, it can give you a sense of how the ETF has performed under different market conditions. Once you've chosen your ETF, the final step is to monitor your portfolio and rebalance as needed. This involves buying or selling shares to maintain your desired asset allocation. This is important because over time, some investments may perform better than others, which can throw off your original asset allocation. Investing in ETFs is simple and straightforward, but where do you learn more about them? Subscribe to the channel for more informativeness.